Hi, everyone, and welcome to our webinar today. And we're going to go over some information on private schools, K through 12 financial reporting and model changes. But before we get started, I want to go over some housekeeping items. I want to make sure everyone knows how to use GoToWebinar. And just so you know, in the webinar pane, you can maximize or minimize the presentation by using the red and orange arrow buttons. And then during the webinar, we definitely encourage you to ask questions. In the webinar pane, you'll be able to see a questions box where you can type something in, and then our presenters are going to be able to answer those questions throughout the presentation or at the end as time allows. And I want to make sure everyone has good audio. So if you're on your phone, please select the phone call audio option. And if you're on your computer, make sure you select the computer audio option. And then if you are joining us today for CPE credit, just be aware that you must be on your personal computer, no smartphones, and you have to be using your own unique URL. You need to be logged into our software for at least 50 consecutive minutes within the scheduled time frame of the webinar. And then you also actively need to respond to at least 75% of the polling questions. So today we're going to have 6 polling questions. Make sure you answer 5. And then also we need you to complete the evaluation survey at the end of the webinar. And then just as a side note, so everyone's aware, you will be able to download the slide deck and the recording of this presentation within the next 48 hours. And I do want to make sure we go over our learning objectives for today. So today we're going to review the nonprofit reporting model changes, discuss the difference of the quantitative availability disclosures and the qualitative liquidity disclosures now required for all nonprofit private schools. We're also going to look at specific availability and liquidity disclosure examples for various types of private schools. And so now I want to go ahead and pass it off to Aggie. Go ahead.
Thanks so much. Good afternoon, everyone. I'm so happy to have Armanino with us today. This is a year in the making. I first saw the Armanino folks present at an MBOA program, and then I saw them again at the Business Officers Boot Camp, and I thought to myself, we have got to get them to present to our independent school folks in Pennsylvania, and here they are today. So I'm delighted to have Kathy Ferguson with us and the Armanino team, and we really appreciate all you're doing for independent schools. So I'm going to pass it off to Kathy.
Aggie, thank you very much for that. It is our great pleasure and our honor to be here with you guys. We take a lot of pride in the work that we do with private schools, and so we are honored anytime we get invited to different organizations to speak about things that are coming up, particularly whenever it comes to the new reporting standards. So my name is Kathy Ferguson. I am a nonprofit audit manager. I work exclusively with nonprofits, specifically with private schools and with entities that have single audits. I come from a little bit of a different background just because I am a auditor by trade now, but before that I was in a private school. I spent about 8 years in the business office at a all-girls private school in Texas. So I have a unique perspective and really kind of appreciate what you guys do and offer.
Awesome. So now we're going to go ahead and go into our first polling question. So how familiar are you with the updated reporting requirements for nonprofits? So A, I know there are changes coming, but I'm unfamiliar with the specifics. B, I've heard the specifics, but I still don't feel that I know or understand them. C, I'm somewhat comfortable with my knowledge of the new requirements. Or D, I am ready to implement. So go ahead and fill in your questions.
Okay, we'll give everybody just another few seconds. So it looks like the votes are in, about 95% of the votes are in, and it looks like most of you live in that lane. There's quite a few of you that are in the top areas where you kind of know what's coming, but maybe you're not super familiar with them. Some of you are, and some of you, it looks like are already comfortable with some of the new requirements, but you're not quite ready to implement. I'm really impressed with that 11% that they are ready to go. So my hope is honestly that today during this presentation that you move one step further down that ring and that you really get to where if you knew there were requirements coming, but you didn't know the specifics, you now know more of the specifics. If you're comfortable with the requirements, but you're not quite ready to implement, I want you to feel like you're more in a place that you could be ready to implement. So that's our goal for today. We're going to go over just an overview of the changes. The main changes that are coming about are really your net asset classification changes, the reporting of your expenses, the cash flow statement, and the liquidity. There are some nuances and there are some other smaller changes that have also come out, and we'll address some of those as we walk through this presentation.
Okay, so we're going to go ahead and go into our second polling question. So please let us know which statement best describes your endowment. My school does not currently have an endowment. My school has a donor restricted endowment. My school has a board designated endowment, or both, that your school has both a donor restricted and board designated endowment. We'll give everyone a few seconds here to get their answers in.
Okay, so it looks like answers are in. We have 100% voted. We really did this question to get an understanding of who our audience is. I know when Angie and I, when we were talking ahead of time, it was really important to us to know exactly who we're presenting to. So it looks like a lot of you have both a board designated and a donor restricted endowment, about 80%, and then there's 20% that have none. So that's really important as we move forward. The first change we're going to talk about is the net asset classification and the related disclosure changes. So for the net asset classification, this is something I think all of you have heard about. Those of you that say you're familiar with it, it's going to affect those with endowments more so than those without endowments. And I'll talk a little bit about why that's true. Currently, there are 3 net asset classifications. So you'll see temporary restricted, unrestricted, and permanently restricted when you look at the financial statements. It's now moving to net assets with donor restrictions and net assets without donor restrictions. One of the things that I like to point out here is sometimes we get caught up when we say, oh, we're moving from 2 to 3, and we lose the value of the word donor. I would say that is one of the most important things and beneficial things that FASB did here. A lot of times, if you're not super familiar with the set of financials or nonprofit accounting, or even if you are, we can get confused by that word restricted, and we can think this is about liquidity. Can I spend the money? As opposed to really identifying this is not just money that is able to be spent, but this is money that is restricted specifically by a donor. And so I think it was really smart that they added that word in there and they clarified. The reason that they did this change is really to create a little bit more continuity, and also with the changes in UPMIFA, it really blurred that line between the temporary restricted and the permanently restricted. Based on the conservative spending policies, before UPMIFA, you never spent out of corpus. That was just, you could not spend from corpus whatsoever. After that change, and with the conservative spending policy rules, there were instances where you could. And so then it really change the meanings of the temporary and permanently restricted words. So now we're going to move to a section where we just say net assets with donor restrictions and without. Here's an example of a statement of financial position. And what you'll see on here, if you look way down at the bottom with the net assets, you'll see that there is now with donor restrictions and without donor restrictions. So it'll simplify a little bit there. On your statement of activities, you'll notice there are now 2 columns as opposed to 3 columns. So that'll kind of help readers as well. The less information, the less columns that are on there can sometimes clarify and make it a little bit easier to understand and a little bit easier to read. The other thing that I want to point out is not only did we change from 3 classes to 2 classes, but some of the entities that I've spoke to, they've been very excited. Oh, great. We no longer have to track or disclose what's in temporary restricted, what's in permanently restricted. But we're really encouraging you keep all of those temporary restricted and permanently restricted schedules. One, because there will still be disclosure requirements that come out that you still have to disclose that information. The other thing is there are also new disclosure requirements specifically around your board designated. I know several of you, 80% said you have a board designated endowment. Before, there were not a lot of a lot of disclosures that were required around that. And now they've enhanced those disclosures. So you will have to disclose more information about your board designated endowments. Some of the other things that I specifically want to point out with the net asset consideration that you'll see as part of the new enhanced guidance is gifts that are restricted for the acquisition of PP&E or construction, long-lived. They've also changed that. In the past, you had the option to either release those based on the placed in service method or based on how they are depreciating of your depreciation schedule. That is no longer in effect. Now you'll only be able to release gifts for long-lived assets over the placed in service method. So I just kind of want to point that out as we're looking at this. So this is a disclosure very similar to what you've seen before. This is your net asset with this is your net asset with donor restrictions disclosure. This one will be a new disclosure, and you'll see at the top, you'll see the separation of those restrictions that are for specified purposes, those that are for the passage of time, and then down in the bottom section, that is really your endowment, right? Those are subject to school spending policies and appropriations. This is the disclosure that really hasn't changed a whole lot. This is just showing your change in endowment. The only thing I'd point out here that has changed a little bit is, one, there are no longer 2 buckets or 3 buckets. There are now 2 between your with donor restriction and without donor restriction. And the underwater portion of your endowment, it is now shown in the with donor restriction column, as opposed to in the past it would have been in the unrestricted column. Also, one of the other small nuance changes to this FASB change is your investment returns. You no longer have to break those out. You can net your investment returns, your direct cost of investments with your investment returns. So any fees associated with your investments, you can net it with your returns here.
Awesome. So now we're going to go ahead and go into our third polling question. Just as a reminder, we do have 6 today. You need to answer at least 5. So prior to implementation, do you currently have a separate statement of functional expenses in your financial statements? Yes or no? We'll give everyone a few seconds to get their votes in. Okay. We're going to go ahead and close the polls.
Okay, so it looks like 63% said yes, that you currently do have a statement of functional expenses, and about 37% of you said no. So that's a good indication, kind of tells us a little bit of, the audience that we're looking at there. So for functional expenses, in the past, you simply had to list all of your expenses by function, right? Which is just your program and supporting. You would say, this is how much we have in general and program, and this is what we have in management in general, and this is how much we have in fundraising. Now you have to break those further into both program and by nature. So nature would be by salary, benefits, occupancy, depreciation, those sorts of things. Also, as a reminder, like we talked about earlier, your investment expenses, those can now, the direct internal and external investment expenses, those can now be netted with your investment returns, so they will not be required to be in your functional expense statement any longer. So here's an example. When you break this out into function and nature, you actually could put it on the face of your financial statement. You could put it in the notes. What we primarily see is entities are just choosing to do a statement of functional expenses, and this is the way that statement would look. You have your program activities and your supporting activities. One of the things we're really encouraging our entities to do is stop and evaluate now. Do your programs, are they what you want them to be? Do you have them defined well? If you have a general bucket for programs or you want to reevaluate, is this program, if we look at the mission of our organization and we think through what are the programs that we're offering, are those well defined on our statement of functional expenses? And if they're not, this is a great opportunity for you to redefine that. The other thing I would point out is one of the things I hear people saying when they are doing their functional expense statement is sometimes there's a thought that management in general is not mission related. It is. Everything you do is mission related, so everything that you do would fall under that category. Those are just items that support the mission and the programs of the school. The other thing is fundraising. If you raise money, if you have contributions, then you should have fundraising expenses. Occasionally, we'll see an entity that does not have anything allocated to fundraising, and we question that. If there's contributions, we would assume there would be some fundraising costs. A lot of people, so a large percentage of you said that you already have a statement of functional expenses. So one of the things that I usually hear in my schools that I audit that have a statement, they're like, yeah, this isn't really going to change anything. We already have this statement. And that's true, but there are some nuances that you will want to evaluate. A couple things that have changed is now you are required to disclose your allocation method. If you allocate expenses between programs, management, general fundraising, then you have to disclose how are you allocating that. Are you allocating your depreciation based on square footage? Are you allocating the president's office based on his time and his effort in those different areas? And so as it's a new disclosure, it will also be something your auditors will say, show me the support for how you came up with that allocation method. The other thing is anytime FASB adds words into the guidance, if there's a set of guidance and they add strategic words, then we pay attention to those. The words that they've added to clarify what goes in programs versus what goes in management in general. So they've added the term direct conduct and direct supervision to really clarify that program should only be those things that are direct conduct of the program or direct supervision of the program. Some of the things that we would say should be in management in general, just anything that's oversight, business management, accounting, payroll, those sort of things we would expect to see in management in general. Another thing that we would encourage you to evaluate now, this whole change really creates an opportunity for all of our entities to stop and evaluate how am I telling my story? If there's something in your financial statements that you have had in there for several years, and you've thought this might present better if I did it this way, but you don't want to make a change, this is the time to make that change. Make that change with this new guidance change because the look of your financials are going to feel a little bit different anyways. So let's reevaluate all of the notes. For your functional expenses, one of the things that we encourage is if you've always had a functional expense statement, have those functional expense categories really aligned with your 990 categories. And would it behoove you if they did? Is that something that you think would add value? And it's something we're encouraging our entities to really consider as they're applying that.
Hey, Kathy.
Yeah.
Can you talk a little bit about why the consistency between the 990 and the financial statements is important for boards?
Right. So your 990 is disclosed on GuideStar. It's probably, your 990 is something that I would argue for a private school is sometimes seen even more than your financial statements, right? So if we put a lot of thought and our energy into how are we going to allocate on our financial statements, I think there's a lot of value that. Let's carry that forward over into our 990. There's still going to be some differences between the amounts on the tax basis versus GAAP basis, but in the same token, having that comparability and having a donor that does have both of those happens to pull your GuideStar report. They look at your financial statements and to see that consistency. I think there is value in that. And I think when there's inconsistency in that, it can also raise some questions.
Thanks.
So the next change is a statement of cash flow. This is really an easy change. But it's one that the reason we leave this slide in here is I want to point out when FASB came out with this new ASU 1614, they actually came out and said this will be two-part. They will come out with the first set and say, here's our first set of changes. And then there are some other things that they tabled and decided we'll discuss these later, and we'll come out with a second set of guidance updates. The cash flow statement is one of those that there were some proposed changes to, and they opted to wait on some of those changes. So for right now, there was a lot of conversation about whether we would have to change a cash flow or not. We do not. All they've changed about is they've said you're now allowed to use either the direct or indirect. And if you choose to do the indirect, there's no longer a reconciliation. When you choose to do the direct method, there's no longer reconciliation to the indirect method required. In saying that, know that when that next set of guidance comes out and those next set of changes, we don't expect them to be nearly as encompassing or as expansive as the current set of changes that we're talking about, but we do expect there to be some changes here with the cash flow and where you present certain items on the cash flow, but FASB's still in the conversation section of that.
Awesome. And now we're going to go into our fourth polling question. So the question is, I believe the following reporting model change will have the greatest impact on my financial statements. So please select the option that best sounds like you. So changes to the net asset classifications, updated functional expense statements and disclosures, changes to the cash flow, or new quantitative disclosures on availability and qualitative disclosures on liquidity. We'll give everyone a few seconds to put in their answers. Okay, we'll go ahead and close the polls.
Okay, so our poll is showing that the change to the net asset classification is the one that people feel will have the greatest impact, and the second is the liquidity disclosures. Angie, Aggie, does that surprise you at all?
No, not at all.
Yeah, we hear a lot about the disclosures to the liquidity, and a lot of people have a lot of angst about that. And I would say the reason that people have angst about the liquidity disclosure is really because this is the first time FASB has any requirements for liquidity on nonprofits, short of just telling us that we should list our balance sheet in liquidity order. You have to have some disclosure like that, but otherwise there's not really a liquidity requirement out there for nonprofits right now. Now,
but Kathy,
yeah.
And the reason why this doesn't surprise me is I think some of our schools are really struggling with this whole question of liquidity.
I agree. And how, one of the things that I would say to that regard is, how do I present that, right? So let's say that at the end of the day, I know that I am not in a very liquid position because of some of the restrictions on my cash, but am I going to have the ability to tell that story? And I would say yes. That's what we want to meet here today for and walk through specifically. And we've left, almost half of this webinar open to talk about liquidity, is because we really want to talk about some of the different ways that you can present that and present that to your readers to where they can understand your position. FASB essentially, they felt like when nonprofits had no liquidity disclosures, it really impeded the reader's true picture of the organization. They couldn't really see who the organization was and what that position was. So that's why they came about with this change. It's really to improve the quality of information that users have so that they can assess the liquidity of nonprofit organizations and know how that they're going to manage that exposure to liquidity risk. Okay, so let's jump in and let's kind of look at what these disclosures are going to look like. So there are two kinds of disclosures that are now required: a qualitative analysis and a quantitative analysis and disclosure. The way that I think of this and the way that FASB aligned it is a qualitative disclosure it's defined really as your liquidity, right? And the quantitative disclosure is the availability of your assets. I think that makes it a lot easier to understand as we look at it going forward, and hopefully you'll agree with me. So you'll see throughout this presentation, I've taken those definition words and paired them together. So as we talk quantitative, I really want you to think availability. As we talk qualitative, I really want you to think liquidity. Okay, so here is for your quantitative disclosures. Your quantitative disclosure discloses the statement of really the best place to get started with where do I start with my quantitative disclosure on availability. And I would say the best place is looking at your statement of financial position. Let's look at the assets that you have. This can be disclosed on the face of your statement of financial position or in the notes. We're really seeing everyone lead towards notes where it really is a lot to put on the statement of financial position. So we're not seeing people go that direction. But there's many options, particularly on the availability disclosure, on how to do that. And we'll show you some of those. So what assets are considered to be not available? So we just kind of have a little chart here to help us think through what are some of those things that we have on our balance sheet that would not be available for disclosures. Financial assets that cannot be converted to cash, like your accounts receivable or your notes receivable that are due in, that you're expecting to get paid in more than a year, your contribution receivables that are due out in greater than 1 year, investments that you cannot redeem within 1 year, any donor restrictions that limit your availability of your assets, your endowments, your trusts and life income, any contractual or legal restrictions, whether they're debt service agreements or bond agreements, any state requirements, and then any internal limits imposed by governing boards. This is the one a lot of people are struggling with. They've created a board designated fund, and yet now they have to pull it out of their liquidity. So if you've designated it for the future or financial assets that are a designation of your long-term investments, any quasi-endowments, all of that will have to be pulled out and shown as non-liquid. So here is an example of the quantitative disclosure. And I'm going to say there are two types of quantitative disclosures. One is really kind of a gross quantitative disclosure, and one is more of a net. This is more of the gross disclosure. And as we walk through some of these examples, I'll show you examples of both. This is the one that I think a lot of people will lean towards. This is the one where you start with your financial assets and the gross amount of your financial assets. And this will tie back to your balance sheet. You'll be able to go back and trace back that $25 million to your balance sheet. And then below that, you're going to back out everything and show these are the things that are unavailable to be used for general expenditures within the next 1 year. Then you're going to have your qualitative liquidity disclosure. So initially you're saying these are the assets that I have that are available in your quantitative disclosure. Now you have your qualitative disclosure. We're saying now how liquid is my position? How much, what is available? You're going to qualify that availability disclosure. Initially you said this is what's available. Now let's qualify that and let's give some color and some meaning behind those metrics. Some of the things that you'll want to consider is how do you manage your daily cash requirements? Are there liquidity reserves? Are there board designated funds? Are there lines of credit that are available? Some other things that FASB said that you may want to consider is if there's any unusual circumstances like special borrowing arrangements and requirements imposed by resource providers, if you have any known liquidity problems that are significant, you may want to disclose that. If the nonprofit has not maintained the appropriate amount of cash or cash equivalents to comply with donor restrictions, then you'll want to disclose that here. And then any information about significant limits resulting from contracts you would want to also disclose. So let's kind of look at what that would look like. So we've seen the availability and how that ties back to your statement of financial position. Now let's look at what does the qualitative disclosure look like. Now, I've got several of these today, and I don't want to spend time just reading to you, but I think it's important to really draw out certain words within these disclosures, and then it helps us identify the difference in some of the disclosures that we're going to talk about in the future. So this one, shameless plug, I do have to say, I said that I listed the Armanino Foundation here. I will say this is not true. This is not the amount of money the Armanino Foundation has, but we're very proud that we do have a foundation to help nonprofits. So shamelessly, I listed that as the organization. So in this disclosure, we just said as part of the Armanino Foundation's liquidity management, it has a policy to structure its financial assets to be available as its general expenditures, liabilities, and other obligations come due. And then we kind of go down and talk through to help manage unanticipated liquidity needs. The foundation has a committed line of credit. We disclose the amount of the line of credit. That line of credit can be drawn upon if we need to. Additionally, the foundation has a quasi-endowment. Although the foundation does not intend to spend from its quasi-endowment, other than amounts appropriated for general expenditure as part of the annual budget approval and appropriation process, amounts from its quasi-endowment could be made available if necessary. However, both the quasi-endowment and the donor-restricted endowment contain investments that have lockup provisions. So any of those kind of things are what we're going to want to disclose here. So I hope what you're seeing here is the availability disclosure is saying these are our available assets, and then the liquidity disclosure is really coming behind that and qualifying. Those are available, but this is also what we have and we'll be able to use in the next 12 months. Okay, and this is an example of a combined disclosure. You will see some entities that go this direction. A lot of our entities are choosing the chart format for the quantitative disclosure, but you can see here that you could do it this way. Here you'll see everything in red is the qualitative liquidity disclosure. Everything in blue is the quantitative availability disclosure. So we just go through in blue and say the nonprofit, and we start listing out the assets that they have available. And then we come behind in red and say they have a goal to maintain their financial assets and the amount of time that they expect to have it. And then really kind of talks through their policy on that we've kind of talked through on the other one.
Awesome. So now we're going to go ahead and start with our fifth polling question, which is what are the gap requirements for liquidity disclosures prior to ASU 16-14? So is it there are no liquidity requirements? The only requirements is to disclose liquidity of assets or present the balance sheet in liquidity order, or you must quantitatively disclose the availability of funds within 12 months of the year end and qualitatively disclose the liquidity of those funds.
So we'll give everybody just another second or two. Okay, so it looks like just about everybody's in. So yes, right now the requirement is that all you have to do is either list your balance sheet in liquidity order or have some similar disclosure that way. No other requirements. The reason that we had this polling question is really to drive this home. It's really changing. This quantitative and qualitative disclosure are new. And before that, there was really nothing else, nothing significant. Listing them in liquidity order was really minimal. And so this is one of the biggest changes. Okay, so here, let's walk through what this might look like. And so I've got a couple examples, maybe 3 or so from different types of private schools that I thought we would just kind of walk through, we would talk about, and we would talk about how, what that might look like for you guys. Okay, so here's a private school statement of financial position. One of the things that I will point out on here, just because I think it'll help with your disclosures later, is if you'll notice your investments there are $29 million, and they have a really good position here, right? Like they're $88 million in assets. So, you know, they're doing pretty good. They've got $76 million in their net assets. So initially looking at this entity, we think they're in great shape. So let's kind of move forward and look at what their disclosures might look like. So this first disclosure is their qualitative disclosure. And you'll see some of those same things that we said we would talk about. We're going to say, yep, we have a policy to structure our financial assets to be available for general expenditure as they come due. We talk about the school's business office by policy attempts to maintain adjusted operating reserve balances equal to a minimum of 20% of the school's annual operating budget. We talk about our long-term investments. We say our long-term investments include endowment funds consisting of donor-restricted endowments and board-designated quasi-endowments. And then we say the board-designated quasi-endowments could be made available in its entirety if needed. Then here we're also going to talk a little bit about what future income we're expecting to collect. Future tuition and fees to be collected for the upcoming 18-19 school year approximate $20 million. Based on our historic collection experience, which is approximately 100%, the school expects to collect that $20 million within the next 12 months. Now, that's not one of your financial assets, but it is a qualitative disclosure to really drive color home to the reader of the financial statements about what your position is and what money you're expecting to collect and how you expect your position to shake out in the next 12 months. Then we say short-term contributions receivable consist of unconditional promises to give expected to be received within 1 year. And we talk about what those are. In the events of an unanticipated liquidity need, the school could also draw upon its $5 million available line of credit. That, again, is something that is not going to be on your statement of financial position because it's available. And then we say the following is a quantitative disclosure, which describes the assets that are available or expected to be available. So then we look at the availability. This is that gross presentation that we talked about earlier. And you'll notice here the investments are $29 million, right? So this is that gross presentation. We start with the assets. Those agreed back to that statement of financial position we looked at. And then we start backing out. We're going to back out our donor imposed restricted investments that are in endowments. We're going to back out any board designated investments, any designated investments. So we're going to take those financial assets of $49 million. We're going to back them down. Financial assets available to meet cash needs are now $36 million, but we also have a line of credit available. This is the difference in that net disclosure. So I was saying you had the option to present net or gross. You'll see on the gross disclosure, here we list our assets, we back out the things that you cannot apply, we end up with $36 million. We're going to end up with the same numbers at the end of the day when we do our net presentation. However, this investment number is really that $29 million for gross minus the investments that are backed out. So this kind of just gives you a good feel for what the two different methods of presenting that quantitative disclosure would be. Oops, wrong way. Okay. So now let's look at what might your liquidity disclosure look like if you're a big endowment school. So if we look at this statement of financial position, this is a big endowment school. There's long-term investments of $55 million here. They've got $127 million in assets. They have net assets of $113 million. Initially, we're going to look at that school. We're going to say, great, looks like a great position to be in. So let's look at the qualitative availability disclosure. Here, you'll see the things in black. Those are the things that are very similar. The things that we'd want to add because they do have an endowment is we're going to want to add discussions about that endowment. Short-term investments include amounts without donor restrictions that have been internally designated by the board for specific purposes. Give the amount. These amounts total $5 million. Additionally, as described in the notes, the board has a policy to appropriate the expenditures 5% annually of the trailing 12-quarter average of the donor restricted endowment fund investments. Therefore, $1.5 million of the short-term investments at year end related to the appropriations that will be spent within the next 12 months. So this is a time for you to really talk about what is my spending policy? What is my conservative spending policy? And what do I think my endowment draw will look like over the next 12 months? And be able to give that as a qualification of your availability footnote. The school is expected to receive proceeds from a charitable remainder trust. You can put that in there. The certificates of deposits approximate $200,000 are required as collateral for the notes payable, and they will not be available for use. So having that disclosed. And then long-term investments include amounts without donor restrictions in the long term. These investments also include endowment funds consisting of donor restricted endowment and board designated quasi endowments. There are certain limitations on availability of long-term investment funds, totaling approximately $47 million related to donor-restricted endowment funds at year end. And then we're going to say the school has the line of credit available to use and the balance available to be used. So if we look here, we say the available balance is $3.4 million. We took financial assets of 68 million, and we dropped them down to 3.4 million in this big endowment school. So that's a big change, right? This is, I think, the area where Aggie was saying that this is where most of our schools are concerned. As we looked at you guys, a lot of you have board designated endowments. You have donor endowments and board designated endowments. So all of that's going to have to be backed out. Here you've got your donor imposed restrictions, investment for donor endowments comes out, but then also you're pulling out your board designated endowments of another 3 million or so. So let's look at what might it look like. Let's say there's new construction going on with the school, because schools have all different phases of life, right? So you've got your endowment disclosures, you've got liquidity, but what happens when you go into that new phase of life where it's a new construction process? So here is a balance sheet from a school that is going through construction, and you'll see here they've got 40 million in assets. They've got another 36 million in net assets. So here we're going to keep a lot of the same language about what is our policy, what does our investments look like, how are we using that money, but we're also going to include the school completed construction and commenced operation of the new school gymnasium on this date. Total costs related to the gym were approximately this. We're also going to include our future upcoming tuition as we did in the other ones. And then we're going to talk through the investments and what that looks like, particularly as it relates to the construction. Investments include amounts with donor restrictions established to provide financial aid to students. As of year end, approximately 5.5 million of the amounts is related to the corpus and cannot be utilized, and approximately 1.5 of accumulated earnings and appreciation. Additionally, as described in the notes to the financial statements, the board has a policy to appropriate the expenditures of 5% on an annual trailing 12-quarter average of the donor restricted endowment fund. Therefore, $275,000 of this investment at year end related to the appropriations will be available to spend in the next 12 months. So here is the new construction quantitative availability disclosure, and you'll see this is gross. And so again, we've got, here's your financial assets, and then we're going to back out. Here's our donor imposed investments. Here's our investments with our donor endowments that we're going to need to back out that 6.7. Total investments here were 7. We back out the 6.7. That leaves us with our total financial assets available to meet our cash needs for general expenditure in 1 year is 1.4. This is that same disclosure, but on the net basis. So you would have the option to either do gross or net. And you can see it just looks a little bit different. Here you're showing your investments are only $275,000. That's because you're taking your 7 million and backing out the investments before you disclose. So either of those options are available. I personally believe a lot of our entities are going to choose to do the gross method, but as you're looking at different sets of financial statements, I want you to know what your options are. Okay. So when is all of this effective? All of this is, yeah.
Kathy, before you go there, can we just talk a little bit about liquidity percentages? So I know when we prep for this, we talked about, you know, what Armanino recommends to schools, what ISM recommends to schools. Do you want to talk a little bit about that?
Yes, I'm happy to.
Okay.
So liquidity is liquidity is hard, particularly in the way that we're having to disclose this. We would recommend that our entities have a liquidity of 10%, right? Like that is where we would like to see them at a place of, but in the same token, you know, whether they're 10%, 15% in that range is a good, healthy range. But I really think you also have to skillfully look at your qualitative disclosure and say, are we building our case for the future? Are we taking our, you know, some people are going to take their financial assets, they're going to say, this is what we have to leave. And let's say that you're below that. Let's say that you're only at 5% of your assets are available to be spent within 1 year, right? Or to meet your expenditures within 1 year. Then Does that put you in a worse situation? Maybe it's something you want to work towards, you want to build towards, but also really using those qualitative disclosures to come back in and qualify why are you in that position, what are you expecting to collect over the next year. The other thing that I would say that we would expect to see is a real understanding of the entity and really being able to justify those and talk about those before year end. So if your year end is June 30th, it's one of the reasons we wanted to have this presentation now is you have time before year end to make some decisions. If you're bored, if you're looking at your assets and you're like, we're well below what the industry, most of the industry is 10 to 15% of their expenditures, they've got that available to use in the next 12 months. If you're well below that, are there some decisions that you could make now before year end, before it's time to disclose? We don't want our schools to be in a position where it's well after year end, we're getting ready for audit prep work, and then they're saying, gosh, our liquidity position does not look strong, and we really would like to make some decisions to adjust that, and you will really be too late. So that's why we think it's good for everybody to start talking about those. And like you said, Aggie, really kind of looking at what is their percentage now.
And to recognize that June 30th is just around the corner.
It is. And we all get busy, right? So we're all trying to close the end of the month, and we've got all of our other kind of things going on. We've got our admission cycles happening and all these other things. And this can be one of those things that is not a fire drill until after year end when you're doing audit prep work. But really, it's got to be now. It's got to be now that you're not only doing that, but also putting together. One of the things we recommend for our organization is put together a pro forma financial statement now of last year. So go back and take your last year financial statements, or get with your audit team to take your last year financial statements and put them in a pro forma set. So bring them up to the new standard now, so that when you're looking at last year's, you can say, this is what we would have presented. If we had done last year's financial metrics and we put them in the new standard, this is what we would be presenting. This would be our financial statements. Take that to your board. See if that's how you want to present. Start having those liquidity conversations now with your board. In your February, your March, your April board meetings, really start talking about, is this the way we want to qualify our financial position? Is this our quantitative disclosure? Or are there things that we want to be able to tweak? Are there buttons we want to turn now to really adjust the way that may look in our 630 financial statements?
Yeah, and I think some of the other things that we talked about, and maybe you'll talk about this shortly, is, some of the things that schools should start reviewing now. Your investment policy, your board designated funds, your line of credit, those kinds of things really will impact, how you're going to tell the school's story.
Yes, absolutely. Yeah, that's in one of our upcoming slides. I completely agree with you. I think that you're right on track. We've got to start evaluating those things. And hopefully you've already been doing those. But if not, you still have a few months. As you said, this is impactful now, right? So this is not something that we can put off. Some people did early adopt. One of the things that I will say is, in the year of adoption, your liquidity disclosure and your functional expense disclosure is only required to be a 1-year disclosure. It doesn't have to be for a retrospective application if you're presenting both years, if you're doing comparative financial statements. However, everything else has to be comparative. So to that point, I think a lot of our entities are opting, a lot of our nonprofits and our private schools are opting to do a single year statement this year, simply because of that retrospective application of the new standard. If you do not choose to do comparative financial statements, then you would only have to do liquidity and functional expenses in the year of adoption and not retrospectively. And then as Aggie was saying, let's talk about a little bit, what do we need to do? What are our steps from today? What do we need to do to get ready for this? We need to determine the impact of each change will have on our financial statements and really discuss and document our liquidity and our reserve policies. What are our conservative spending policies that we put in line, when we, for up MIFA back a few years ago? Do we need to evaluate those? What is our spending threshold? What is our drawdown percentage? And we're going to need to now disclose those things. Evaluate the impact the liquidity footnote will have internally and externally on, and determine how to best manage that story that's being told, right? So what does that look like to our board? What does that look like to the other readers of our financial statements? We need to determine if changes are needed to our chart of accounts for presentation purposes. For the new net asset classifications, we don't expect to see a lot of people need to change their chart of accounts, simply because the net asset classification, you still want to be able to keep up with what's temporary restricted and what's permanently restricted for disclosure purposes. But for the new functional expense statement, we do think that there's a potential that it could be that there could be some changes to the chart of accounts. And then, is your software adequate? Does your software provide for that? Do you have anything else, Aggie, to add to that?
We had also talked about making sure the head of school, the CFO, and the advancement director get on the same page, because you've got to all be pulling in the same direction. And sometimes, those three key individuals who deal with finance committee and board, aren't always on the same page. So having that sort of overall conversation before getting too far into this, I think would really be helpful.
Yeah, absolutely. Completely agree. Yeah, I think it's a great point to bring up. The continuity between those teams is imperative, and really imperative in making sure that you're telling your story and that everybody's on the same page in the way that the story is being presented to donors and to other readers of the financial statements.
Perfect. And we did promise 6 polling questions, so we're going to go ahead and launch our last one. So now we want to know, how familiar are you now with the updated reporting requirements for nonprofits? Let our team know how we did. So it's either I know where the changes are coming from, but I'm unfamiliar with the specifics. I've heard the specifics, but I still don't feel comfortable, or that you still don't understand them. I'm somewhat comfortable with the knowledge of the new requirements. Or the last one, I am ready to implement. So go ahead and put in your answers. We'll let the polls open for just a few more seconds.
Okay, well, that is great news, because it looks like everybody has moved a little bit further down the line. There's no one in the top that knows the changes but is unsure how to use the specifics, and most everybody has moved down. And that was our goal, is really, we know we're not going to take you from nothing all the way to ready to implement, but we're really happy to see that there were some changes there. Do we have time for questions?
Yeah.
Okay. I think I saw somebody's hand go up a little bit ago. Is there anybody who has any other questions? We have just a few more minutes here that we could answer a few. Do they just type the question? Mm-hmm.
So Kathy, we're going to make this presentation, the slide deck, available to attendees. Is that correct?
Correct. And everyone will get the emailed presentation and recording within the next 48 hours. And we can also share that with you, Aggie, if there's any one-offs that you want to share that with your team or anything like that. We can also send that out.
That would be great. And then the other thing that I think might be helpful is, if you have any templates that we could share with our member schools, that would be really helpful. We would certainly, let them know that they're from Armanino, but I think, particularly with some of our schools that don't have large staffs of, accounting professionals, it might be helpful just to have a template to be able to jumpstart their conversation in their offices about how they're going to do this and pull together their information for their audit and things like that.
Absolutely. And that's how we designed this presentation. So when we share this presentation with you, one, we wanted to give you lots of examples on
Yes.
how to really put this into practice, what the different options were to put this into practice. I will say the actual FASB standard has lots of other examples in there. And then we have some other tools that we can give you if you're not doing the functional expenses currently statement. We have a tool that we can kind of help you guys with that will help you align that with your 990. So we can certainly make some of those available as well.
That's great. Thank you.
Yes, no, thank you. We really appreciate the opportunity to present to you guys. I hope that everybody, I'm not sure if people are coming out to MBOA, but we'll be out there as well. Love to put a face to a name. So if you do come, please come by and say hello to us. And then also we have another presentation that will be available that's really going to talk more about how do you get ready for your next year's audit. And next year's audit is June, right? And so it's June, the year of implementation. So what do you need to do and how to successfully be ready for your audit? And we're going to make that presentation available on March 13th from 9:30 to 10:30 a.m. So we're hoping that all you guys can come back and that invite anybody else that would like to join, because our goal is really to reach as many private schools as possible. We really feel like whether we currently work with you or whether you work with somebody else, good financial reporting from a private school is good for all of us in the market.
And that time is 9:30 to 10:30
Pacific.
Pacific time. So that is 3 hours difference. So that'll be 12:30 our time on the East Coast.
Perfect.
Gotcha. We actually, so before we put this slide out there, we'll update that so everybody has that information. That was a great catch. Thank you, Aggie.
Actually, it was one of my colleagues here who caught that.
Perfect. That was great. Thank you so much.
Well, good.
Aggie, thank you for inviting us.
Yeah, thanks for being with us, and thanks for getting us started on this process. I know that our schools are going to really be thankful that they tuned in and got the jump start to this, because it's a little scary.
Yes, it can be, but with the right tools, we'll all get through it together.
That's right.
Okay, well, thank you so much. Have a great day.
You too. Bye-bye.